Talking Economics, Emerging Scholars. Welcome to the podcast by the Center for Economic Research and Graduate Education, Economics Institute. How do differences in expectations and financial literacy shape household financial decisions, such as choosing a mortgage or planning for retirement? In this episode of Talking Economics, we welcome Marta Cota, a CERGE-EI PhD alumna and tenure-track assistant professor at the finance department of Nova School of Business and Economics in Lisbon, whose research lies at the intersection of macroeconomics and household finance. Welcome, Marta.
Hi, thank you. Thank you very much. I'm super happy to be back.
Well, we're very happy to have you here. Your research provides interesting insights into financial decision-making of households. I would like to start with your work on mortgages, one of the biggest financial decisions the households make. Specifically, you explore the role of financial literacy and search efforts on the decision. Can you tell us more about the methodology you employ?
Yes, for sure. So in everything that I do, I try to start from the data, usually public data, very available, and then kind of tease out some of the effects, at least through correlations, to find out, okay, what is the thing that I can conclude out of the measures that I'm using. And then based on the findings that I have, build a certain structural model that would tell me, okay, this is the mechanism that might be at play. And so the agents in my model are going to kind of be biased or have this mechanism that I assume. And then this will allow me to use the model for some kind of policy evaluation, because usually in the public data sets, what we don't have is this perfect identification, right? We cannot understand what is the effect of the policy. So that's how I do things. So in that project, in specific, I started to do exactly this. What I did is I used the public data, which kind of had both the data on financial literacy. So there's this financial literacy test that you take. There are 3 questions. You answer to the 3 and you get a score from 1 to 3. And then that was kind of followed with a survey on how do you approach searching for a mortgage. So that was in the US. And in the US, the mortgage is a substantial amount of debt you need to take, preferably when you're young. It's a fixed rate usually. So whatever you decide to start paying at the beginning, it kind of goes on for 30 years. At most. So to that extent, it was my focus was to really shape out and understand what are the differences and what are the patterns that I see among similar people in how they search for mortgages.
You said it's a survey. What are the dates? What is the scope of the survey?
Mm-hmm. So it's the National Survey of Mortgage Originations. And so what it does is what people do, basically, they take out a representative sample of U.S. mortgages issued from 2014 all the way to 2022, I believe, at this point. And then what happens is that people are sent by mail the surveys about the specific mortgage that's in the registry. So in the surveys, they're asked what are their priorities when they were searching, how did the process go, were they happy with it, did they consult with anyone, and there's like a set of, I would say, more than 90 questions that they get to be asked over mail, and then they get to send back their questions. Of course, not everybody is willing to respond, and not everyone is willing to fill in the whole survey. So some things are imputed by the researchers at the mortgage agency in the US. But all of this to say is basically they really try to get at how people think about taking up a mortgage. And so that's why I think, based on the fact that mortgages are a major debt in the US, that's why the survey kind of started.
Mm-hmm. And so what were the outcomes of your work?
So basically what I found is that financially illiterate borrowers, or the ones who have very low financial literacy scores, are the ones who end up searching much less. So they consider a lower number of lenders. They don't consider it as many options. They end up being more delinquent on average. And they end up getting very high rates, as opposed to the financial literate borrowers who might search more. And so the idea then was there's this mechanism of an effective search where people who are financially literate, they understand that they have some options. And then because of that, they might get a better rate simply because they were kind of searching for more. Spending more time. You can think of it as spending more time. You can think of it as taking a look at number of options. Either way, it kind of goes in the same line. And so that's kind of what I found in the data. Based on this, I created a model which kind of, has this mechanism in play. I have this cognitive cost of search. And then I relate it to exactly financial literacy. So financial literate borrowers do not face as high cognitive costs as financially illiterate borrowers. And so with that model, I was trying to kind of first tease out this interest rate distribution that I see, the differences between people who are seemingly similar, but then financial literacy is completely different. And then with that model, I was able to kind of speak to what will financial education do for renters just before purchasing the house.
Oh, this sounds like you are providing very important policy advice, right? To what extent is your work replicable in other countries, and to what extent are the results relevant?
First I would like to believe that I do think about policy. I always, when I start with projects, I try to think about policy first. I think in terms of, so everything that I did that is true is for US data, where again, the mortgages are usually interest rate, so they're fixed over 30 years. In Europe, for instance, the situation really varies by country. Some countries have fully fixed interest rates mortgages. Majority of people would take a fixed rate mortgage, or a hipoteca, depending on where you are. And then in some countries it's fully variable. So for instance, Sweden or Spain or Portugal for that matter, they take up fully variable interest rates. So these interest rates change over time, change with the interest rate of the monetary policy. And then some people take, fixed rate mortgages and then they don't change, for instance, if they don't refinance. So to that extent, what I would, if I had the, ideal data, and I've been actually talking to people from European Commission about this, because there are surveys there that I could actually grab and see how it looks like. I would first focus on who gets to choose the fixed rate mortgage, who gets to choose the variable rate mortgage. So in the US, it is shown that financially illiterate borrowers are the ones who would be going for variable interest rate mortgages more. But they're only maybe 5% in total in the US, so nobody actually cares as much. Whereas I feel like in the countries where we have more of these spreads, on interest rate, on mortgages, that would be more important. So I would first focus on this, who gets to choose which one. But then I think the search is even more so important because of the way the banks work in respective countries. For instance, I have the access to the Dutch data as well, and I see that there are maybe 8 banks that are relevant. And so, searching more, what does it mean? You have only 8 lenders to think of. So, we would need to really think about how can this mechanism work in a set where we have smaller amount of banks.
And so in the US, the number of lenders is much higher, and
Yes.
the search needs to be much, much broader. And is there also like a larger variance in the rates?
Exactly. So first, that is that. Variance among fixed rate is big. The spread can go as far as, 6% between two, I would say, similar families to some extent, of course. It's also, you need to think about the house and stuff. There are a lot of lenders, and that I think what is more important for the US and kind of turned out to be more important for the paper that I was working on is that there are a lot of these non-bank lenders. And so these are not banks. They're not regulated in the same way as banks are in Europe. So they get to play around a little bit more with like how they issue these mortgages, and also what they do, these non-bank lenders, in the US at least, they pack them as something that we all remind ourselves of during the financial crisis, in the mortgage-backed securities. So they pack them in that. So whatever happens to these mortgages afterwards, they don't actually care about. They already sold them in the secondary market. So to that extent, these non-bank lenders in the US are to some extent not as regulated. In the US, that's the case. But then in Europe, I'm not saying that wouldn't be the case. But with regular banks, things are a little bit more, I would say, simple to that extent. What I think the interesting thing, as I mentioned before, in Europe is that, taking a variable interest rate mortgage and letting it float without having a very correct expectation of future interest rates might be actually very harmful for a household, right? So maybe to some extent at certain times, switching from variable to the fixed interest rate in Europe would be something optimal for European citizens. But that, again, depends on the country and depends on the time and expectations of people.
Mm-hmm. So in general, your results are replicable to some extent, or you really need to do a lot of additional work to tailor it to the specifics? So
I think I would definitely... what I do plan to do is really get to this European Commission survey data, to get the access to that and really see if, because they do measure this search. And my kind of hunch is that they measure it because of some reason, right? They do ask people how much they search. So there is still a little bit of this market effect. For instance, like I mentioned, Netherlands, 8 banks, but 8 banks do differ. So I think it does translate. Again, to the fixed rate regimes would be much more easier to estimate, to understand the gap, and then the effects of this interest rate gap among people on like a 30-year span. With variable interest rates, it is not as clear. But I think, there's this aspect that has not been as, I would say, explored in Europe in terms of, who gets to pick which kind of mortgage.
In addition to mortgage markets, you also look at the retirement savings, which is another big decision with their long-term consequences. What are the key factors that determine the retirement savings?
So what I did, again, it seems like all of my research is focused on the US, but it's getting more important, I think, in Europe now. What I try to do is explore the accounts people have, which go kind of beyond the typical 3 pillars that we would have in Europe, right? So for us in Europe, there's this third pillar, which is kind of acts like a voluntary type of account where you add if you want to. And then whereas in the US, there's Social Security claims that you can get once you retire. But then on top of that, there's this private retirement account. And once the private retirement account is private and it's this defined contribution type of account, you as a worker get to choose exactly how much you want to contribute, to which fund it's going to be allocated. You can kind of expect a return on this money. How much will it be? So to that extent, it's very individual in, how much you're going to save and what's the contribution rate going to be. In Europe, these accounts are kind of up and coming. The Netherlands is trying to build this in, like a pure voluntary type of account where you get to choose the contribution and the fund. To some extent, there's some choice of a fund you can make. And then this will add on top of the pensions you would be getting. And so I would say in Europe, even more so with the aging population and the fact that pensions are not getting, larger at this point. There's no young ones to actually finance them, right? The private accounts are becoming increasingly important and popular. So I would say that, Europe is still kind of trying to figure out how much should the government take care of people versus how much should we let people take care of themselves, knowing that there might be some biases in ways they save for retirement.
You analyze the decisions of people, right? So what are the determinants? How do they decide?
What I did find for the US data is that expectations with respect to future income do matter. So what I did find is that low-income workers expect their income to be persistently low. And because of that, they prefer to consume, early on rather than later on. And so they just forego contributing to these retirement accounts. And then they basically end up depending only on Social Security. Or in Europe, there will be pension, for instance. Whereas with high-income workers, I find that, they find it much easier to contribute to something which has like long-term benefits as opposed to short-term, simply because they're not as focused on today versus tomorrow. And so this was kind of the determinant that I found. People have been finding, all kinds of biases when it comes to present bias, like understanding how important today versus tomorrow is, planning for retirement is versus then financial literacy as well. So a lot of things do determine these things. My finding was the expectations.
What are the data that you're working with? So you see the expectations, but do you see how the expectations turn out? To what extent they're right
exactly.
and wrong?
So there's this Michigan survey of consumers in the US asking basically, what do you expect your future next year income to be? And then people state their expectations. And then I followed them in a second year and I found what their income actually was. So I was able to calculate the gap between the expectations and realized income. And then based on these errors in expectations, I was able to divide workers between pessimists and optimists. And what turned out to be the case is that low-income workers are usually pessimists, kind of focusing on very persistent low income, as opposed to very high income optimists who kind of believe that they're going to succeed even more in the future. So that's kind of what I used.
Now, I would like to turn to some other aspect in retirement. We're talking about lifetime earnings, right, which are determining the retirement savings. And in most countries, we know that these are lower for women than for men. So do you observe any differences between genders?
Absolutely. So that's one of the most recent stuff that I've been working on, is actually understanding the difference between men and women and their saving in private retirement accounts, again in the US, again public data. where I show that basically what women do, it's not about the contribution rates as much. So the amount that you get to save out of your income every month is not that different between men and women. But what is the allocation of this money in stocks versus bonds. And so what happens is that men actually get better returns on whatever they contribute. So to that extent, it's not just the wage gap. So the women earning less, and so, they would contribute by default less. It's also how they allocate, because women on average are more risk averse. That's what other studies have found, of course. Women on average are more risk averse, according to other studies. But on top of that, again, with lower income, that means like their future savings are even more depleted potentially than for men. So that's what I found. And then what I was able to relate it to, in my case, is financial literacy. So I've shown that there's a large gender gap in US and also then in the Dutch data in financial literacy. And what I see that for what is interesting, I think, in terms of policy again, is that what I found that for women, financial literacy seems to be more dynamic over the life cycle. So if you were to plot age bins and financial literacy averages for women versus men, you would find that men are very flat in terms of, they have scored 2 out of 3 on average, and they kind of keep it flat for the life cycle. That's what my data does suggest. Whereas women tend to kind of progress over time, kind of learn over time. And so the latest paper that I did with a couple of co-authors on differences in financial literacy and the role of these differences for retirement savings and savings in future basically found that after women get separated, so the moment that they kind of jump into financial independence, they actually learn more, and their financial literacy is on average higher than for women who remain married. So there is some interdependence between being financially independent and knowing that you need to take care of your finances, as opposed to potentially delegating your finances to your husband.
Interesting. I wanted to ask whether you see what are the sources or what are the pushes for learning in women. So why there is a difference between men and women's learning.
So I would say definitely the gold point of our paper is that there's a separation, divorce, or widowhood. And on average, we do find women, being more widowed than men because they live longer. And so when these life cycle events happen, it seems like women learn. And then there was the other thing that we found when women inherit money or inherit a business, this is exactly where, you see this financial literacy increases more over time. So it seems that life cycle events are needed, right? Then what I would definitely say is that for married women, I don't see as much learning. So that is kind of the big difference.
And when you see that they don't learn, they don't acquire the financial literacy, but what about their investments? Is it still are they more risk averse, or do they let the husbands handle their finances and therefore do they benefit from their knowledge?
So I think in the paper that I do, we kind of do not make it about risk aversion. We're actually trying to say that there's this delegation. So what I've been able to do is use the Survey of Consumer Finances and kind of separate between husbands and wives' accounts. And what I was able to show is that women on average hold more of these checking and savings accounts, which would be the ones where you use for grocery shopping or, for kids' clothes and stuff like that, versus men husbands seem to invest more in other types of assets. So there is a little bit of this delegation. But, on top of that, there's this role of confidence, which I think is super important. So in most of these instances where you find this gender gap in financial literacy to be like a one score or one question difference, when you ask women how confident they are in their responses, the usual answer is we're not confident at all. So it's not just about, me knowing how much I know, me knowing about personal finance. It's also about me knowing how much I actually know, which prevents me then from saving as a woman. So that's kind of the two things that we found, and which I think speaks to policy, not only just, let's sit women down, teach them financial literacy, and all will be good. We need to somehow create a nudge for women to invest, which would go beyond their confidence, a gap that they might face.
Interesting. And I understand that like your research is focusing on the US because I think US has been kind of ahead of European countries, and especially the Central and Eastern European countries. We've been seeing only recently, I would say, that financial literacy is becoming a topic, right? And then countries are starting to introduce courses at elementary and high school levels. So do you see change here? What would you comment on the differences between Europe, US, and our region specifically?
So first of all, I definitely agree with you. I think it only has been showing up as of recently in Europe. I think there's a lot more to say for the situation in Europe, mostly because of the gender norms. So what we have so far in terms of European data, which I would say would be the best in terms of financial literacy, is Italy, where gender norms do exist, and then the Netherlands, where to some extent we would like to think of Dutch society as one of the most egalite than the other European societies. So there is definitely a role to understand to which extent, this delegation within marriage could actually then make policy less effective for financial education. So the story in the paper that we have, even though it's in the US data, but we now are retrieving more and more from the Dutch data, trying to really figure out what can we say about the European context. The idea for us would be, why don't we rethink this teaching kids in high schools? Why don't we just make policies a little bit more targeted? Kind of to circle back to the first paper that we talked about mortgages. The idea of the model is to allow financial education or kind of implement financial education for renters who are just about to purchase a house. In the same way, why don't we think about educating a woman about financial literacy as soon as she gets divorced or as soon as she immigrates into another country? And these types of life cycle events when we need to kind of really target when it happens. There is this wonderful meta study by Kaiser et al. From 2021, I believe, where they kind of did this huge study on, these are all of these RCTs about financial literacy and financial literacy courses. So you can think, Africa, Europe, US, high school kids, even like 4 to 10-year-old kids, and so on, to really try to figure out what is the effect of the policy. And results are very mixed. One reason being is that they're very short term. So you can teach kids at the age of 10 to 12, but will they know anything in a year or two? And the other kind of thing is that it seems to come up in the test itself. The 3 literacy score, there's a test, you need to solve it. So maybe you actually you remember the questions and not in the doing, right? So I think, again, the whole paper, and I think where I would like to believe we should go as policy makers or as policy thinkers is to really think about educating people exactly at the time in their lives when they need that. Because, as soon as, for instance, a woman gets separated, this is where the financial independence is necessary. So why not teach her right then and there, as opposed to teach her when she's 16 and then potentially she gets married later on and might actually forget all of the things that a certain financial literacy course had taught. That being said, even having them in high schools, I think it's a good thing to start from something. And I think what will be, I would say, for European context, especially after and during all of the geopolitical situations, is the financial literacy for immigrants. I think this is a very important field, which I think is still a little bit unexplored. There's one or maybe 2 people that I know work on this in Denmark, where they really try to understand to which extent religion among immigrants can affect financial literacy. Because, for instance, for Islam, within Islam, you shouldn't be able to collect money using the interest rates. So there's a lot of things that can be affected: gender norms, religion, and so on and so on. And I think immigrants are a beautiful type of pool of people that we can actually teach about exactly what's happening within the country, right? As opposed to, general financial knowledge.
All these are excellent ideas, but for policy design and development, usually what works best is to have the data that you can, check and see, as you are doing with the US data. Do you see any changes in the European world? Are they starting to collect more data than you could use for designing and analyzing the impact of policies?
Yes. I think right now what they're really... So there's this European Central Bank survey, household survey of finances or something like that. And they have integrated the financial literacy score. So based on 3 questions, 5 questions, and even more. There is, let me just say, the whole thing kind of... It's very interesting that the whole thing in financial literacy as an idea started from Anna Maria Lussardi and Tullio Giappelli and Mario Padula, who are all researchers, phenomenal researchers, but Italian, right? So they saw gender norms potentially affecting financial literacy, among other things. But yet it kind of kicked off more in the US than it did in Europe. So I find that to be very interesting. So in terms of data, I think Italy has by far the most. Again, maybe because of the bias, right, due to the researchers' nationalities. And I think it tends to expand. Then there's Dutch data. And over time, we will be seeing more and more of these. But as more household surveys start popping up, even though they're self-reported, they're surveys, they tell us a lot about the delegation within marriage or family in general, economics. And then on top of that, this financial literacy that we can actually then use as a motive to target for policy.
With this, I would conclude our talk. It was very interesting and inspiring, and I see that there is a lot of ground for future research.
Thank you, Katka. It is a long way ahead, and I hope that, we get some data and we also get some ideas flowing around.
Thank you.